Welcome back. Let's talk markets and the U.S. economy with our expert guest. Jeremy Siegel is Emeritus Professor of Finance at the Wharton School of the University of Pennsylvania. He's also a senior economist at WisdomTree, the U.S. ETF company. Jeremy, thank you very much for joining us. Let's talk about, first of all, the Fed. The market disappointed late in the year by the most recent dot plots, which indicated 2 rate cuts in 2025. What is your call on what the Fed does in 2025?
Yeah, I mean, I think the only way that you're going to get many more than 2 is not going to be good news for the market, because it means, I think, that the economy is slipping. And in fact, if the economy remains relatively strong, I think that we're going to get maybe 0 to 1. So yeah, I mean the scenario, and I talked about this in September, that there's going to be multiple rate cuts in 2025 is just the economy is just way too strong for that. So I think we're going to have rising yields as the bond market recognizes that. And I think one of the reasons that small stocks in the U.S. had faded at the end of the year was that disappointment that we're not going to have as many rate cuts as we thought.
What happens to the profile for growth stocks in this lower rate environment? Conventional wisdom tells us that growth investors like lower interest rates, but if the rate cuts are coming more slowly than the market would prefer, what happens to growth stocks?
Well, growth stocks, I think, are going to have to be an earnings situation. I mean, their earnings growth has been absolutely extraordinary. They are priced for extraordinary earnings growth. There can't be any disappointments when you're selling 30, 35 times earnings, or in the case of Tesla's, 70, 80, 90 times earnings. Everything has to be at or above expectation. So I think what, I believe that the U.S. market will experience a correction in 2025 this year for the first time in a while. Now, that's a 10% or more decline during the year. I'm not sure it'll end up that way, but I think there's a lot of challenges to the U.S. economy.
Speaking of price earnings multiples, and you just tossed out the number 30 or so for the high profile growth stocks, the S&P 500 at large is now trading at 24.6 times expected earnings. What is your view of that valuation on S&P 500 companies at large?
Yeah. Well, I think it's an interesting, I just picked up this morning the data for expectations on 2025 earnings, and on the basis of those expectations, which I think are too high, as I'll discuss, we were at 22. Now that's still high, but those it's expectations of a 16 to 17% gain over 2024. Now that I don't think is going to be realized. I mean, in the last 2 years, we've had 8 to 9% gains with good economy. I mean, GDP growth above expectation. So when I take a look at that and put in an 8% growth, which is still very healthy for the S&P, that's when I do get the 23-24%. 23-24 price earnings ratio, close to you mentioned, and that certainly is a challenging ratio. But it's a bifurcated market. Mag 7 is almost 1/3 of the capitalization, and as I noted, they're selling in the 30s. If we take out that group, we are much closer to 18, 19, which I think is a reasonable level for, I guess, the S&P 493 that don't belong to the Mag 7. So again, we've had this for 2 years, and it got worse towards the end of 2024. This bifurcation where we have those 7 stocks just sort of running away with the market, and the rest of the market languishing. I think there's a good probability, I'm not going to say a certainty, that we could see a reversal of that trend in 2025.
Yeah, that was my next question. Market history surely tells us that the outperformance by one small group of stocks cannot continue forever. What would it take for this rotation, this much talked about rotation away from those stocks into smaller cap stocks to really take hold in an enduring way? As you've noted, or as you alluded to, the Russell 2000, the key small cap index, did rise through the second half of 2024, but really nosedived later in the year as investors once again went back to those big tech stocks.
Yeah, absolutely. Now, I think what would bring down those tech stocks is chinks in what I call the AI narrative. I mean, clearly AI and the excitement about AI and the narrative about AI has been very, very strong ever since really ChatGPT was developed, 2 years ago. Been driving all the market, much of the market since then. Now, if there are chinks in that armor, in other words, if there are stories that, hey, firms are not buying as many chips, or they're not getting the productivity gains that they had hoped for, or there's more competition, or margins are pressured. I mean, there's a lot of scenarios. And by the way, those scenarios have not yet been realized. So the narrative is intact at the present time, but it must stay intact. That's why we can't get bad news on that narrative. Otherwise, I think certainly you will have that reversal. But again, I say it's intact at this time. I see little signs of questioning, particularly Blackwell may not be the only chip that is available. Energy requirements are very high, and energy prices seem not to be going down at this particular juncture. And of course, we're talking about challenges, certainly on the tariff front, challenges on the labor market front with what's going to happen with immigration and labor supply in the United States, and valuation. So all those are hurdles for the market. Not predicting any crash or really a bear market, but this is really a year perhaps for a pause. Now, going back to history, we have had 25% plus years of consecutive. We've had two, and this is going to be the third. The third one, the last time that happened was in 1999. And we all knew what happened in 2000. It was not a pretty picture. So yes, can this be another 25%? Certainly. But that sets us up for a even more precarious 2026, in my opinion.
Okay, we're almost out of time, but I'd love to get your thought on gold. It's very, very common these days to hear people predicting $3,000 gold. Are you in that camp? Not necessarily. I mean, gold, is interesting. I picked out the inflation early and advocated gold, and then it lagged, and everyone went to Bitcoin, and then finally gold woke up really late in the recession. The trend is good. I don't think inflation is at a runaway. I think that inflation is 2.5%, 2.5 to 3. It could still run, clearly. I'm not going to, it's not overvalued in any major sense, but I think with the challenge of higher interest rates, and since gold doesn't have a return, clearly higher interest rates are a cost for gold holders. I think that we will see more muted gains this year. Jeremy, thank you so much for your insight. That's Jeremy Siegel, Emeritus Professor of Finance at the Wharton School of the University of Pennsylvania. He's also